Welcome to Private Capital Perspectives, a podcast from The Lineup. This podcast is where family offices, real estate operators, and investors share how they're deploying capital and navigating today's private markets. I'm John Pugh, a family office capital partner, real estate developer, and investor, and I'm also your host. Each episode, we bring you real conversations from the front lines of private investing. I promise no fluff, just practical insights on what's working now and what's coming next. Today's guest is Laura Maher, seasoned real estate and corporate attorney and a trusted legal advisor to deal makers across the private capital and commercial real estate world. Laura is a partner at Nelson Mullins, a leading national law firm where she brings more than a decade of experience from top law firms, private equity platforms, and in-house counsel roles. She focuses her practice on complex real estate transactions, joint venture structuring, private equity investments, and corporate deals, often serving as outside general counsel to clients looking for practical, business-minded legal support. Whether it's an acquisition, a fund formation, or a joint venture negotiation, Laura is known for her strategic thinking, her sharp understanding of both legal and business dynamics, and her ability to get deals closed efficiently. Welcome, Laura.
Thanks, John. Thanks for having me. It's great to be here.
How'd you get interested in real estate? How'd you kind of get into the business?
Sure. So 13 years ago, I started my career in real estate. I was born and raised in Florida and spent some time in the Northeast. And then after law school, decided to return to my home state and establish my practice here. I started out at a very large law firm in West Palm Beach, focused on commercial real estate, and learn the tools of the trade from the very best. I work closely in a sort of apprenticeship model with a seasoned real estate partner that's now unfortunately passed away. Had a great time at that firm. And since then have spent time in-house at two global real estate private equity firms. Also have significant experience with real estate developers. And I'm now returned to private practice and very excited to continue building my practice and my book of business, working selectively with clients that align with my mission and vision. So very excited.
Can you maybe speak a little bit more to that? How do you typically work with clients? How do you enjoy working most with clients?
Sure. So my background is varied in that I have experience on both the capital provider side as well as the sponsor operator side. And each of those two groups provide different opportunities, right? So on the institutional side with the capital providers, I understand how they work. I understand their processes. They've got investment committees. They're preparing investment committee memos. Things are very formal, very regimented, and very systematic. And for those clients, I prepare, detailed playbooks. We have very clear expectations. We have we make it so that I'm almost unnecessary. We set them up for success. So it's whether it's me or someone else, they've got a guidebook because they're doing tons of volume and deals, and they can't afford gaps or some lawyer's subjective opinion on one thing or the other. So that's the one bucket. And then on the sponsor side, that's kind of where I get to have a little more fun, right? It's the entrepreneurs. It's kind of it's the people that are maybe don't have an extensive background in real estate or have been doing it for 30 plus years but never got a college degree. Sure. And they're very street smart. They're very savvy. It's exciting and fun. And for those clients, they really care what I think. They don't, they care about my professional judgment. And the capital providers do too, but I get to play a little bit more of an integral role in the business decision-making on that side. So I'm advising not just, what's the best in class legal recommendation here, but what's practical strategy? How can I help you navigate this world? So that's great. And as far as selecting clients, I mean, I'm excited to be building my book of business and find those opportunities for people who fit that program. And that sounds like that's what they're interested in.
Fantastic. Yeah. I mean, I think we're really speaking directly to the audience, really, capital allocators as well as sponsors here. So I think that's That's
Yep.
great that you're joining us today. What are the key elements in partnership agreements to minimize the potential for disputes? That's a kind of a general question, but I think there's always key clauses, right, in operating agreements that can be pretty meaningful.
Right. So I think
Yeah.
management is a key component of that, and understanding and having clear expectations of how the day to day is going to run. There are a couple different frameworks you can use to set up your management structure in a JV. The first would be that the capital provider is the manager and runs the show, with the sponsor in the back seat. The second would be that the sponsors in uh, the driver's seat as the manager of the company, with the capital provider having a list of major decisions, right? And then the third would be that there's a kind of a hybrid with both parties having a role as a type of manager, usually the capital provider being the capital M manager and the sponsor being the administrative manager or something like it. But in each of those
Mhm.
scenarios, especially if you're working with an institutional capital provider, they'll have a framework or a paradigm that they expect to see in all of their deals. And so, yeah, the negotiation of those major decision rights, including, the ability to call additional capital, the ability to finance or sell, the ability to spend money over budget, perhaps, you know, over a certain percentage of the annual budget. All those are heavily negotiated and important for
Yeah.
both sides to understand. Where
Where do
where
you just kind of digging more into that? Where do you see where do you think see things go wrong when roles and responsibilities maybe aren't clearly defined?
yeah.
Is that a big piece of it? Yeah.
Yeah, I think expectations, going into it, when I was in house at the private equity firms, I would try to make it very clear with our sponsors kind of how we like to see things and how the day to day should go. As an example, for service agreements, we had like a template service agreement that we like to see with all the indemnification, all the insurance, things that are protective and necessary for everyone.
I think, just understanding, the question I was curious about is, I think there's a lot of times roles and responsibilities, right, are the key piece. It seems like that, having clear expectations is an important piece. Is that kind of where you find some issues that maybe could be headed off with a better written agreement?
Certainly. Yeah. I think the agreement is one thing, and the what happens in practice is often where the
Yeah.
rubber meets the road and where you find
Yeah.
issues.
Sure.
So when I was at the private equity firms, we'd always have language requiring certain material contracts to be approved by us. But in practice, the sponsors may run off and sign whatever they want, right? They have a pen, they have authority, and perhaps they're used to doing things that way. So setting
I see.
expectations about how that goes is important. And by the way, these rules and these procedures are beneficial to both parties. Contracts that have robust indemnity language, insurance requirements are beneficial to both parties, and oftentimes the capital provider may have more of an interest in making sure things are buttoned up nicely. But
Sure.
on the sponsor side, I think as well, if you're a strong sponsor, you've been doing this for many years, you may be saying to the capital provider, like, get out of my hair. You're 4 years out of college telling me what to do. Like, I've I've executed. Okay. You've
Yeah.
you've run a couple
Yeah.
spreadsheets, and like, just trust me, and you're going to make a lot of money. So it goes both ways, and I think a good partnership is one that both parties understand the value that each party brings to the table, and where
Yeah.
they can support each other.
Is part of I mean, I've been in a lot of operating agreements and partnerships, and so much of what I've been fairly fortunate because most of the people I've worked with, I've known in some regard prior to getting into the partnership, but I've also had some good fortune that everyone I've worked with has been fairly honest. But is there, in terms of like you mentioned, like a sponsor kind of running off and just doing whatever they think is right. And like,
Right.
I mean, I've heard that story many, many times. And like you were kind of just saying, like, yeah, there's an older guy or gal who's done this 20 years and they've got some
Right.
2 year out of school analysts trying to manage them. Like, is that more of a, do you think that's more of not even a legal thing? That's kind of more of a personality slash, trusted, how much is trust is there in a partnership? I mean, I feel like that's a really big, obviously that's a kind of a big key, right?
Yeah, I mean, I think as important as the legal language is knowing who you're getting in business with, and this is
Yeah.
something I advise all my clients. I mean, whenever I go to represent someone and they're entering into a new relationship, I always, run background searches on everyone, which not every lawyer does, but something to think
Yeah.
about. What
Absolutely.
kind of fights has this person gotten into in the past, and are they likely to get into that type of fight with me? Are they quick to sue? Are they slow to sue? Are they, what's their personality like? And really underwriting that. It's not something you can put in a spreadsheet or in a legal document. It's a sense that you have that, there's trust there. Um, so,
Absolutely.
yeah.
Yeah, there was this funny you mentioned that there's this gentleman that I was looking to get into a partnership with not too long ago, and I ran like a background search on him. He's like the nicest, ran this background search on him, and he must have had like 20 different times where he was, all these random things, legal issues, and I was like, oh my god, I never would have expected that, but you got to do your due diligence, that's for sure. It's
Yeah,
super.
yeah. And real estate, I mean, real estate is kind of one of those industries that attracts all types, it's got, so you really, and not to say that, someone that's got a past can't be, can't change and
Yeah,
redeem themselves. And,
absolutely.
people are totally capable of changing, but just being careful about that. Yeah.
Good to be aware. Yeah, for
Yeah.
sure. Dispute resolution mechanisms in operating agreements. That to me is I mean, I find that a very interesting topic for obvious reasons. The more partnerships you get into, the more you want to have some clarity on that. What are some common ones that you've worked with, and maybe some not so common ones that you've seen?
Yeah, so the classic in a deadlock is the buy-sell mechanism, where, if parties are at an impasse, one party can trigger the buy-sell and essentially say, I'm willing, here's my assessment of the value of this asset. You can either buy at that price or I'll sell at that price. And the other party then gets to make the choice. It's an inelegant mechanism. Sometimes it forces decisions that may not, be timely, or in the case of a party with a lot of capital and the other party doesn't have so much capital, they may not be able to actually act on the decision that's in the best interest for themselves. Like if you are the
Yeah,
person with the 5% interest and now you've got to raise a ton of money to go buy out your 95% partner, you're going to want to make sure that the timelines for exercising that buy sell or closing on the buy sell are long. Um, so that's one mechanism. I mean, you could have, a appraisal mechanism where, the one party can buy the other party out, and you get, two appraisals if they're within a certain percentage of each other, that you average them, or you get a third appraiser.
hmm
And there's a myriad of
yeah,
mechanisms for resolving disputes. But if you play these out in practice, it can often be messy. And again, it goes back to
yeah.
that: who are you in business with? Because these provisions are rarely actually exercised. Most of the time, it's worked out at a business level. So,
Sure. Yeah, you want to do whatever you can to avoid that. Have you
right,
seen, and similarly, the bad boy, bad girl clause, where an operator's maybe not doing what they're supposed to be doing, they're
right,
negligent somehow, and that's
yeah.
triggered. Are Have you seen more disputes as of late, the last couple of years, given some of the challenges in the capital markets and such?
Yeah, I think certainly people who advise LPs are raising the alarms. They're seeing more issues with sponsors and LPs conflicting. I would say on this topic, just going back high level, when you're in a structure where you've got a bad boy removal clause, like say you've got an institutional capital provider, a Kane Anderson, like where I used to work, or a Westbrook Partners, and they have the right to kick out the manager. If you're and say in that case, the manager loses their promote interests if they're bad.
Sure.
If you're invested in the manager's entity, the GP entity, you want to make sure you've got robust notice and cure rights with that capital provider, meaning you can't be dragged along with the manager's bad acts. And these corporate structures can get complicated with many levels of management and levels of investment. And I think unless you're properly advised, you may miss that you could get taken out in a very bad way. You could lose your economic interest because of someone else. And you always have to be thinking, how can someone else materially impact my position? Something that I didn't do, but now I'm in a bad position because of them. So, yeah.
Yeah. You always have to consider those implications. There's a gentleman that I know that was in a partnership for many years, and he ended up getting taken out by one of his partners. They were both GPs,
Right.
And he lost a pretty meaningful amount of his economic incentives, that he was really working for.
Right.
And it was just a poorly structured deal on his part, right? Unfortunately,
Right.
for him, it's just, and the more you see either a lot of money being made or lost, the more the legal comes into it, right? So
Correct.
So, in terms of case studies, are there any specific partnerships that you've kind of worked on that are particularly interesting from a structure standpoint that might be good to kind of discuss or talk about a little bit? Because I love the more I can learn about partnerships, the better. I'm certainly no lawyer, but as you know, the more you understand agreements, the more effective you can be, right? And as a sponsor, as
Yeah,
an investor.
definitely. Yeah, I know I'm seeing globally just a more creative financing and structuring solutions, both on the debt and equity side.
Yeah.
So I've actually been working on a lot of deals recently involving CPACE financing.
Oh, okay. Sure. Yeah.
Yeah, which is um, a program that funds certain energy efficiency improvements,
Yeah.
and it's on
Those
the
are for
debt
is
side.
that for existing buildings or for acquisition of existing or brand new ground up
The
development?
ones I've worked on are ground up development, but it can be used to renovate. And so, yeah, the one interesting deal that I worked on recently, it was a complex hotel development deal involving CPACE, but we had bridge financing and historic tax credits involved and multiple layers with ground leases, and it was very complicated. And in those scenarios, you're herding cats and you're making sure that the investors' interests, don't conflict with each other, or that their remedies are exercised in an orderly fashion. So, you establish a priority of who gets to exercise first, who has cure rights. But the more people you involve and the more parties you involve, the layers and layers of complexity, that get added.
So in that one, were you structuring the partnership, managing the transaction? What was more your role in that one?
So yeah, so both I represented the construction lender. It was originally supposed to be a different setup. So we went
Okay.
through many iterations. It was a seller, and then the seller sold to a developer and also made a construction loan. So that was my role in that. So more on the debt side and less on the equity side. I guess on the equity side, um, like I said before, some of the more interesting deals that I've worked on involved multiple layers of equity investment, where I had to make sure the cure rights flowed through, and that my client that was at the GP level, didn't lose out and had the right to fix whatever issue was going on with the capital provider.
Yeah, and
So,
that's really like you were saying before, kind of the having enough time for the GP to kind of solve
right.
whatever problem might have arisen. Yeah.
Right.
Are you seeing a lot of preferred equity nowadays as well in deal structures? I know that's become more common. Have you seen that a fair amount more? Yeah.
Yeah, definitely. I mean, the story for the past, I don't know, 7 years or so, ever since, yeah, has been like debt's becoming more popular, preferred equity, which is quasi, it's kind of in the middle, but certainly people are more interested in uh, venturing into the more conservative areas of the capital stack. And you can get good returns on, debt and preferred equity, certainly, especially if you even further leverage those positions. So, yeah, I mean it's definitely becoming more prevalent.
Are you working with debt funds at all to help to debt funds fund deals? Or are you more focused on private equity and sponsors?
Yeah, the firm definitely has relationships with debt funds, and at Kane Anderson they had a debt fund I was involved with. So definitely have experience on the debt fund side. Many of our clients have both debt funds and equity funds, and so different people at the firm may be working on different elements of it. So it's
Gotcha.
something we definitely come across,
Yeah.
frequently. Yeah.
So I'm not that familiar with preferred equity investments. I know what it is. I've never done one. We're considering doing some preferred equity investments in across the southeast right now. Are
Right.
there any specifics around preferred equity that you're that's helpful to kind of keep in mind as you're looking at setting up a deal with a sponsor?
I mean, definitely, making sure the economics are correct. The waterfall, the preferred equity will come out first with the return and
Sure.
then the return of capital. So
Yeah.
that's the main focus. And of course, control rights, major decisions, those are all things. Just as with the structures we were talking about before, all of those issues remain in a preferred equity structure, as well as exit rights. You want to make sure your client or your investment horizon matches with what the sponsor or what the other investors' investment horizons are, as
Yeah.
far as like when you want to exit, and if not, what are the mechanisms for you to, get out of that position? Can you transfer early? Can you, um, do you have a put right? Things like that.
Yeah. Yeah. So it's just more, maybe a little bit more on the exit strategies thing, because that's seems to be where there's a lot of potential for, kind of differences of opinion. Is there, I mean, you clearly going into a deal, you're going to very clearly, as a sponsor, you're going to very clearly state this is what our expectation is for this deal. We're going to go in, we're going to build a ground up multifamily. We're going to lease it up. We're going to sell it. It's going to take 3.5 years, whatever it might be. And because the capital markets have been, let's call them a little more interesting than they had been the prior,
Mhm.
prior, whatever, 10, 20 years, there's a lot to be, there's a lot of liquidity problems right now, right? There's a lot of sponsors and investors that have liquidity shortages. I've spoken with a few myself recently that are interested in maybe redeploying capital, but they're tied up. So in terms of exit strategies, is you mentioned the put option. Is that a typical thing that's written into an agreement, or how can investors kind of get out earlier than maybe the sponsor typically? Because I've never been in the LP seat myself, so I'm kind of curious.
Right. Yeah, so you want to, I mean, first stop is to look at the transfer provisions in your LLC agreement, often, or whatever partnership agreement, whatever structure you have. But yeah, often transfers are not permitted without the manager's consent. Sometimes transfers to certain family members or related parties may be permitted, and you may be able to squeeze into one of those exceptions. Like if you want to transfer 90% of your position, and you're willing to stay on as manager, but perhaps you could qualify for an affiliate definition. Um,
Mm,
but
mm.
in most cases, you'll be seeking consent to do that. But if you are in a position where you want to transfer, again, having that conversation with your partner or the sponsor, um, I mean, they may be open to it. They may not be, given the liquidity, the state of the markets right now, and they may not be
Yeah.
able to find a replacement capital provider for you. So,
Mm.
yeah, it's a challenging spot. A lot of times, it's wise to pre-negotiate some of those some of those rights up front. A preferred equity investment or an investment with very limited control in the entity, I could see the argument being made that, well, this is an investment. This needs to be a freely transferable investment for it to have any value. And you sponsor shouldn't care who's writing the check as long as the money's there, and they're not. So yeah, these are all
Mm.
negotiable things, but
That's where having a great advisor comes in handy, right?
yeah, absolutely. And the more proactive you can be, the better, at the outset. But having an attorney to navigate through these things and talk it out is important. Someone with, you know, expertise, but also that human element. I think a lot of times that is missing. Even when
Mm.
you're in the tensest of debates or arguments, being able
Hmm.
to level with someone and say, you try to express to them, I'm a rational person. Okay. We both have maybe different interests, but I can see reason. And I know, I hope you can see reason too. I think that goes a long way. I think people really appreciate that approach.
Yeah, absolutely. I mean, I think it's just such a challenging climate today for real estate development and investment. I think, one of the things that's hasn't been a real thing, at least for many years, is bonds. Bonds are now competing with real estate for capital, and people need to be able to be more liquid given the volatility we're seeing. And hopefully there's a cut in the near future from the Fed that'll help unlock a little bit of money, I think. But I'm hopeful in the next 12 to 18 months we'll see a bit more. So just in terms of your business, how are things going in terms of your activity? Do you see it getting busier right now, or is it kind of a little slower than it's been? Like where do you see things going over the next 6 to 12 months?
Yeah, so a big part of my practice is long-term development of projects, and I'm now working on a couple of projects that are multi-year, multi-hundred-million-dollar investment. So it's not like you can just pump the brakes on that when, interest rates are higher. You kind of have to figure it out because you've got, commitments made to governmental authorities and to counterparties. So those I'm staying busy with. I will say the projects I'm working on are a little bit more niche than perhaps in other climates, in other, economic environments. I mentioned CPACE is something that I'm seeing pop up a couple, from time to time. But and I'm working with some family offices that are a little less sensitive to, they've got large amounts of capital and they're less sensitive to some of these things. So that's been fortunate. But yeah, I will say, the bread and butter, like, private equity, we're buying $100 million deal and, just a plain vanilla deal. Like I'm seeing less of that in my practice. But I will say there's always opportunities, in every climate. If you sit on the fence forever, you're never gonna make anything happen. And our
Yeah.
firm and myself, my practice, we are always moving and always working to make make the most of whatever situation. So we just opened a data center and industry group, which
Oh,
is
great.
to capitalize off of those trends. We've got experts in the energy industry as well as real estate, construction, and development. And I'm also seeing opportunity as well in the medical office space, which has always been a solid, asset class, even in down markets in the pandemic. So that's proven resilient with cap rates still staying pretty low. So
Yeah.
yeah, very, very. I mean, that's exciting. And multifamily, I think you mentioned earlier, multifamily, we may see good opportunities because construction starts have been at, pretty low
Absolutely.
in the past year. So we may see good opportunities given the supply constraints. So yeah,
Yeah, 100%. Yeah,
yeah.
I'm working with two family offices right now, looking at the southeast. One of them's interested in purchasing a portfolio of industrial, and other one's interested in deploying capital into new deals, whether they be multifamily or whatever. And but it's a kind of like you described, is typical kind of family office, is they're playing the long game, right? That's really something I've seen. Have you, what specifically, anything specific about family offices when you're working with them that you kind of keep in mind that's important? Because obviously those groups are very different than dealing with a typical private equity shop, right?
That's right. That's
Yeah.
right. Yeah, I mean, I think what's nice about working with family offices is you get to bring your institutional experience to bear at a very personal level, and I think they really do appreciate it. They
Absolutely.
appreciate that experience, and you see a lot of the family office people that are hired to run these family offices. They're people from Goldman Sachs, Morgan Stanley. I mean, high-powered, educated, smart people running. So it's nice to work with them because you're working directly with decision makers, and you get to share your experience. I think from a family office perspective, sometimes there is a need to bring in like a third party expert, especially if the family office is considering ground up construction. I think it can be challenging if you are the lawyer, you've got your family office, CEO that's typically
Hmm.
like a finance person,
Yeah.
um, and they're thinking about construction. There needs to be someone who's wearing the hard hat day to day who can look at the plan. And you have an architecture background, right?
Yeah,
So
that's the role that I've served in the past.
yeah,
Yeah,
okay, there you
exactly.
go.
So
There you go. So
it's
I
very
think
helpful. Yeah.
that's really helpful. And putting the pieces together for them, it's not always just like here's the legal language. It's working, with high net worth individuals. They have their personality, their own personality, their own preferences, and paying attention to those small details. Um, you know, in South Florida, I have the opportunity to work often with high net worth individuals that are buying residential property on the island, and like over $100 million deals. And it's not something that I would say is my bread and butter day to day. I work on commercial, but for the right client, if it's a favor to the client and it's a large transaction, I'll handle it. And um, in those cases, things like you know, making sure the timing works for when their furniture is going to be delivered, and making sure the wife is, like that their life is smooth and seamless and happy, and those things really matter. It's the soft side of law, I would say, and yeah, it's a pleasure working with them. They're great clients.
Yeah, that's my experience as well. I think you have to be you may have to be a little bit more patient at times. You have to be a little
Mhm.
bit more understanding that it's not necessarily always a professional business. There are people and family members involved in terms of decision making as well. The investment committee at a family office is a father and a son and a daughter, maybe, right? So it's there's a lot of family dynamics that you have to understand and be aware of. And but once you but it's, to me it's also very rewarding too, because you get to know some great people and you have the
Right.
opportunity to really develop nice long-term relationships that are it's definitely a little bit more personal.
Hmm.
So wrapping up, I think we've touched on a lot today. What's the best way for people to reach out to you, Laura, to follow you on social media? What's the best way to kind of keep in touch with you?
Yeah, so LinkedIn is probably a good jumping off point. Again, it's Laura Mayer. Just search me on LinkedIn. On there, I should have my email and phone number. And yeah, I'm at Nelson Mullins, so you can also go on the Nelson Mullins website. But happy to be of service to any of your listeners and form new relationships as we all navigate through this sometimes rocky economy.
All right, wonderful. Thanks so much, Laura, for coming on.
Yeah, you're welcome. Have a great day.